Morning, everybody. How are we all doing? There's my camera. There it is. How are we all this morning? Morning. Who are we there? Mark, Danny, FTNet, Barry, Leon, Yusuf. New Zealand and Odd are killing me. Yep, they are. They are very, very squeezy at the moment. We'll have a look at them in a second. Yeah, there's a lot of movement going on at the moment and a lot of uncertainty. So it's a bit tricky to navigate this market at the minute, to say the least. Morning, Ace. How are we doing? So we're going to go through the normal stuff this morning. Look at the news. There isn't any anyway. Look at what's happened overnight, because there's a major change overnight with the Ukraine situation and with the US, and see if we can unpick what this means, basically. There's more news coming today from Trump about investment in the US, and he's basically dumped Europe. So quite what this is going to mean for the markets, it's very, very, very difficult to forecast. Sorry, wait one sec. Just in the middle of doing a notepad update. So we need to look at this morning. Also this morning, we're going to go through the S&P pullback strategy. So I covered this, was it yesterday again? And I've mentioned it a few times in live streams. And there is a set file for the market reversal alerts EA up on a blog post on MQL5. Somebody asked me to go through it in more detail today in the member stream, so I am doing it. And they're not here. So they'll be watching the replay, hopefully. I was just looking at the names. So we're going to cover that this morning. Look at the trend pullback strategy, do some back testing on it with the position trader EA, just to show you the logic behind it and what happens basically with the S&P. I might adjust it, actually. I'll leave it as it is for the minute. We'll look at that in a minute anyway. New Zealand and Odd are correlated with US stocks. Not really, no. They're commodity pairs. So basically, the commodity pairs are the Aussie, the New Zealand, and the CAD. So they run with commodities. The main change we've had to do with commodities. Hang on, something's just coming. Oh, that's this morning. Trump tariffs on Canada, Mexico, China are ineffective. So China to impose 15% tariff on US goods. So China are battling back against the 20% tariffs that Trump put on yesterday. So we're moving forward with the Canadian and the Mexican tariffs, basically. What was I looking for? Yesterday's the OPEC news yesterday. God, so much news at the moment. It's almost impossible to navigate this market at the moment from a fundamental perspective. There we go. So OPEC could pause or reverse the decision basically to update. Sorry, what are they doing? Output hikes. Yeah. Proceed with the output hikes that they're looking to put in place. So basically, if oil production goes up, oil price drops, basically. There you go. There's a chart. So what this is in effect doing is reducing the price of oil by creating a surplus. So we have the oil barrel count every week that comes out on a Wednesday. If the count is up, it's negative oil, and if the count is down, it's positive oil, because obviously it's a supply and demand driven commodity. So the less of it there is, the more expensive it becomes. So you can charge more for something that is rarer, basically. Same with gold and all the other stuff. So that's how commodities tend to operate. New Zealand and Australia are large commodity exporters, as is Canada with oil. So when the cost of commodities basically goes up and down, their currencies strengthen and weaken accordingly. So at the moment, we're seeing and also when there's times of trouble, you get a lot of investment quite a lot of the time in commodities, because commodities are always going to be required. So if you want to put your money somewhere safe, it tends to go into commodities. So we get a lot of movement when there's uncertainty in the market, and this is basically what is happening at the moment. Obviously, with what's going on with Trump, I mean, all this stuff that's going on. He's now completely suspended all aid to Ukraine, so there is no aid to Ukraine. If America gets its hands on all the Ukrainian minerals in this deal, it's going to be bad for the Australian and the New Zealand economy, because if they are now a main player, US, in new commodity markets, the demand for Australia and New Zealand is going to drop. So it's all interlinked with what Trump is doing at the moment. He's completely shaking up world order. We've never seen anything like this. It's unprecedented. There's that word again that we had in COVID, but it is unprecedented. So navigating the markets from a fundamental perspective at the moment is virtually impossible. And you're going to see a lot of volatility and a lot of squeezes coming through as the market participants look at it and decide where they should be putting their money. It's going to get moved around a lot, but the crux of it is, as we've seen many times before, the faster it does something, the faster it undoes it as well. So if you look at the last Canadian move that we had with the announcement of the tariffs, they were undone 48 hours later. Exactly the same thing can happen here. So it's very, very difficult to call at the moment. I've got quite a lot of exposure on the Aussie and New Zealand at the moment, and those are the two that are really squeezing hard. So I'm long Aussie and New Zealand, and they're collapsing on this deal. So it's getting to the point where it's going to need to start getting cut today, basically. So very difficult to navigate. We are still pushing. Here we go. So we are still pushing today. So there's a little bit of weakness coming through on the Aussie. Yeah, further weakness coming through today on the Australian dollar, New Zealand dollar against the CAD. It's going to be, so it's the same thing at the moment today. So this market at the minute is just getting rid of any commodity investment in New Zealand and Aussie. So the Australasian economy suffering basically, but it won't take much for this to kickstart a move to the downside, but we need some kind of let up, basically, some opposite news to drive this. Today, we've got no news. We had the monetary policy meeting minutes this morning for the Australians. There wasn't anything exciting in there. Retail sales haven't changed. There's nothing they really mentioned in those meeting minutes this morning that were negative, apart from the fact that they see more downside than upside, which is fair enough. I'm just trying to find where that was. There we go, RBA. So yeah, basically all the upshot of this morning was there's more downside than upside long term, which we kind of know anyway. So there's nothing really new in there. As you can see, there's nothing in red. So yeah, very tricky situation at the moment. Not been in a situation where we've had quite so much shake up in the market at the same time. We've got complete withdrawal from funding for Ukraine from America today. Overnight, there's been more talk about Europe needs to stand on its own 2 feet. We've said we need to stand on our own 2 feet, but we need America, and America just turned around and gone, no. So where do we go from here? And how is that going to affect economics throughout the world? Basically, we just do not know. So it's going to be a tricky week ahead at the minute. Every single day, every single hour, there's potential news coming out with Trump at the moment. So it's just a case of sitting there and waiting to see what happens. So I'm going to go through the zones and everything this morning, look at how extended everything is. Key this morning is looking for levels that we've got available to do aggressive drawdown control. So that's what I'm going to look at this morning. Let's just quickly look at the indices. Lovely day on SIH yesterday. Clean breaks to the downside on the DAX. You're kidding me. Really? Really? That's TP. Seriously, you hit my TP and you didn't honour it. Okay, so I've got break-even stop on that short because the break-even stop has kicked in because we've hit target. Didn't close the trade out. That's annoying. I'm going to leave it running. Okay, so short breaks on both. Let's just look at the other side. So if you were in the live rooms yesterday morning, I was saying how frustrating this strategy is. It made back 11% yesterday. It actually made back 17% yesterday, but the final trade of the day was a loser, unfortunately. So we got breaks this morning, short on the DAX. No breaks so far on the FTSE, but we'll see where we go with those this morning. Right. Looking at the history of the Australian dollar, the pressure could continue. Yep, could do, definitely. Yeah. Aussie, specifically Aussie New Zealand. Aussie New Zealand is one of those that can go parabolic when you get an upset in the economics between the two, because they're very close trade partners. But yeah, I mean, anything can carry on going for as long as it wants to carry on going for. Let's look at Euro odd. Yeah, I mean, it's a bit tricky. Because these are different news events. But yeah, I mean, where we are now, look, that pullback there would get you out. Yeah, so big move there. That one obviously undid itself. But we had this parabolic move there. We had a parabolic move to the downside there, which undid. Again, it's always 50%. Virtually always 50%. So there's this is where Fibonacci is brilliant. Yeah. Whenever you get any large move in the market, you will either get a 38 or a 50% pullback if it's going to continue. Yeah. So that 38 pullback, if you can put a fib on any instrument that you're trading at the moment, and your average price is within a 38% pullback, you will get out on a flag break. Yeah. So a flag break really is 23. My class of flag break is a 23 pullback. But a lot of people will look at a 38 as being a flag. Yeah. Flags are discretionary. It's how you class a flag. So to me, that is a pullback. So some people, they will class that as a flag. It didn't break, but it was still a flag. And obviously, as you can see, I got out of that one there. So this is the last one I had on this. Look. Yeah. And at the moment in here, 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5. Yeah. 6, quite possibly. And then we're going to get a pullback because the market there won't be any sellers left. You get the odd one where we get a tiny 23 pullback. In that case, it's a case of shut some, draw down control, and hope that we get further pullback. This is what it's all about. It's about managing your positions and surviving in them, basically. So yeah, I mean, there are instances where it has gone further. If you look at the pound odd as well, that move there. Difficult way you want to measure it from, but I'm going to measure it from there. Yeah, one there. So you know, we're at the extremes that we tend to get to now on the daily charts. So you know, it won't be long. We're 1, 2, 3, 4, 5, 6, 7, 8 days parabolic now. I mean, I'm just looking back here at the last year. And that's not 8 days parabolic, but that's a big parabolic move there, which is around about 1,000. We're sitting about 750 odd now. Got one there, which is 780. Then we got a flag break. That was 800 odd and some weird spike. Don't know what that was. What day was that? 5th of August. But yeah. So yeah, they're all squeezy at the minute. Yusuf, because I noticed when the New Zealand and Oz are squeezing, the US market is red. Yeah, basically, it's all everything. Everything is linked. So you're talking about the inverse S&P. Yeah. So everything in the markets are interlinked. Yeah. So you've got your there's three main areas. Well, it's four main areas uh, of kind of markets, if you like. You've got your commodities, you got your stocks, you got your foreign exchange, and you got your commodity pairs within foreign exchange. So they're all interlinked. When money goes into one, it will come out of the other. Yeah. So whenever we get a safe haven run, everything drops, and the Swiss and the yen rally, and the gold rallies. When commodity pairs run, stock markets tend to drop, and vice versa, or rather the other way around. So it's basically just money moving in and out. So if you think of pension funds, hedge funds, investment funds, they put their money where they think it's going to work the best. So if you do not think commodities are a good thing to invest in now in Australia and New Zealand, because the US is going to take over a load of mineral deposits in Ukraine and start selling it, therefore their market share will drop, you'll start to sell those. Your investments will also come out of stocks within sectors to do with those markets. So the stock market will move at the same time. So when you get it's kind of a fundamental shift or a new outlook as to where money should be invested, everything will move. Because you've got to move money out of the stocks, the shares, the commodities, the countries. Everything has to be moved at the same time. And if there's specific commodities like oil, for example, that are being affected by it, obviously the oil price will drop, which will drop the Canadian dollar. It will also drop the US dollar, because these are major oil exporters. So everything is interlinked. This is why you see everything moving and squeezing at the same time. However, when you have something squeezing, something else is benefiting from that as well. So when you see something massively moving to the downside, the others, euro and the pound, that are not commodity related and service related, will do very, very well. So there's always going to be an inverse, which is why if you've got a portfolio running, something should be making money while something else is getting killed. It's just the way it's just the way markets work, basically. Morning, Chris. Morning, was check. Still can't tell your name. Right, so ADRs and RSIs this morning. There's a load, obviously. Not ADRs. There was a load of ADRs yesterday, obviously. RSIs, we've got loads of 4-hour RSIs. So Aussie dollar and New Zealand dollar being the main ones. So let's go over the 4-hour chart. Look at that. Boom. Swiss franc as well is going to be something that's going to benefit from this, because your money's going to fly into the Swissy. The yen as well. Got a kicking yesterday. I can't find anything that I can demonstrate it with. There we go. The pound. Yeah, so we had a massive weakness in the yen yesterday, all completely undone overnight. Yeah. Again, Japan being threatened with tariffs as well at the moment. You know, you can't really say what's going to happen with anything at the minute. It's just absolute bloodbath everywhere, isn't it? Aussie dollar Swiss pushed that to the downside, so that's 4-hour RSI extension. Again, we're back down here. We've had no pullback from this embedded extension down here, literally just falling off a cliff. Tiny little pullback on this and continuation. We'll look at areas in a minute and levels. CAD Swiss pulling down. That's coming into a nice level at the minute. That's not a nice level. That's something old on a chart. I don't know what that is. Must be from another pair. So yeah, that's coming down hard at the moment. We've got Euro odd. Obviously, I don't need to tell you about these because you're probably in them. Euro odd extended to the upside. Huge move there. Let's take the fib off. So again, look, downside on this one, obviously, because I've got the fib on there. 38 retracement is this propulsion gap here, which we retested and added to. So this is basically the tiny pullback from last week. So that is target to the downside if we're just going to pull back and run. So this is basically the profit take before the next leg. If we are only going to be able to flag, we're going to get down to somewhere like that. So the difference, you know, getting to this level here and my average price, this trade here, if it gets back down to here, is a case of take that off, thank you very much, get rid of this and reduce the size as fast as possible. So the first pullback is going to be drawdown control. Just waiting for the first pullback to happen. So far today, Yeah, we've pulled back. We haven't quite got that reversal alert in on the hourly, but potentially there's an M pattern forming here. So if we see some weakness creeping in today, this could kickstart that leg down. And as you can see, the 23 retracement is only 125 ADR. That's easily achievable. 75% of days we achieve that level. So sorry, 23% of the days we achieve that level. So it's definitely within reach. EuroCAD, again, 4-hour RSI extension. We didn't manage to even pull back from there at all. It just went into this sideways consolidation. Again, big, strong push up there. The big push that we've had this week so far yesterday, obviously today is too early to tell whether we're going to continue it or not. At the moment, there's quite a bit of rejection creeping in today, but that doesn't mean we're not going to continue it. Euro New Zealand, so this one's obviously pushed up into new highs. Last 4-hour candle made new high. So far, we haven't gone anywhere. We're inside bar. So again, good so far. Contraction on lower time frames. So we've got the reversal alert. We're contracting, but look at the wicks. Yeah, there's not really any selling pressure in there, is there? Pound odd. 4-hour still parabolic this week. We literally have not had one bear candle yet this week on that. Totally straight up. Look at this, the entire last week, ignoring that very first open last week, but as soon as we started going last week, I think this is the 9 MA. Look at that hug in the 9 MA. This is a parabolic trend. 9 MA hug is the description of a parabolic trend. You got 1, 2, 3, 4 hours, 4-hour candles last week where we had some sellers. Not interested. Total jump ship on the Australian dollar. Pound CAD, again, weak commodities. OPEC increasing oil production, weak Canadian dollar. Tariffs going on the Canadian dollar today, weak Canadian dollar. It's just an absolute bloodbath of bad news at the same time, in the same week, from commodity perspective and from Trump perspective. It's just economically destroying the Canadian dollar at the moment. So nothing you can do about it, unfortunately. Pound New Zealand, again, parabolic. We had 1, 2, 3, 4 down candles again on that one. We've had one this week. Woohoo. But yeah, so far inside bar this morning at the open, so we'll see. And New Zealand dollar CAD, big strong push down again, continuing on this one. New Zealand dollar Swiss. So again, Swiss franc is going to benefit from all of this news, because if you want to put your money somewhere safe, it's the Swiss. So you've got the currency getting hammered, and the currency that's going to benefit is going to get the biggest move. So again, 1, 2, 3, 4, 5 on that one at the minute. So we'll see where we go today. Euro odd ADR, already got an ADR on Euro odd this morning, not stopping at all. So we'll have a look at the levels we're at the moment and just see where we are. Just quickly see what's these. Right, so DAX TP hit to the downside on SIH, trailing stop on. So there's a TP in. Second trade, single on the FTSE. So I should imagine I've hit target here. Nope, not yet. So stopped out on that FTSE this morning. DAX trade on its way. Yeah, I've got a net profit sitting there of $1,000, 1,100. I'm just going to let it play out. Very weak this morning. Look at this. We've got just had a gap going on the DAX. Right. Let's whiz over to the zones. Just see if there's any yen trades on. Yeah, I've got one yen trade on as well. Not sure that's going to do much today. We'll see. Right. Don't you consider hedge in deep drawdown? Don't you consider hedge in deep drawdown maybe another pair correlated with the squeezed one to limit drawdown if squeezed more? You could do if you wanted to. Yeah, I mean it's up to you if you want to hedge with another pair. I don't like hedging. I just can't do it. So it's not for me. I've modeled virtually every hedge mechanism there is out there. I've never found one that works. I don't think anybody else has either because it doesn't work like that. You can hedge a currency. The thing, if you wanted to hedge right now, so if let's say for example you wanted to hedge euro odd, there you go, perfect. So let's say you want to hedge euro odd. What are you going to hedge it with? That's the question. First of all, what are you going to hedge the euro odd with? The logical thing would be hedge the euro odd. So whatever lot size you've got on, hit that long and just put the brakes on. So that will stop your drawdown in its tracks. But then you've got to think, how do I get out of that? So when are you going to, if you take a long now with whatever lot size you've got on, so you've got 1.5 lots short. So if you take a 1.5 lot long now here, when are you going to get out that long? That's the question. When you're this extended, what you're doing is basically taking a long position after the market has done its long move. What is coming next is this. So you're getting in just as the market is getting ready to turn. So you've got to time that exit to perfection to be able to get out of it. If the market decides to do an A-shaped recovery on this leg because news changes, you are just going to be stuck in a long position at the very worst spot, right at the very high. So you're just going to go into drawdown. By whatever drawdown that is, you're going to go into drawdown again in the opposite direction. Not hedge with exact 1.5, maybe half. Yep, you could do. Yeah, you could do it that. But my question still stands: is when are you going to get out your long? Do you know what I mean? I did a session on it in the members streams. There's a video in the members streams about hedging somewhere. There you go. Creating and testing a hedging strategy, looking at the pros and cons. There's the video there 4 months ago. Worth a look. I've honestly spent a good, I don't know, maybe 6 months of my life with hedging strategies, trying to make one work, and I haven't found one. There's people on YouTube that go, yeah, it's easy, you do this, that, and the other. I've built their exact models in EAs and they blow the account every time. And if they don't blow the account, what they do is they keep you in a hedge for 6 to 12 months making no money. So all they do is they tie capital up and don't generate alpha. There's no point in not generating alpha. If I want to tie my capital up in something that isn't going to make me a lot of money, I'll just stick it in the bank. I'll get a better interest rate than hedging most of the time. So consider that trade would be a loss. Yeah, so again, my alternative to that would be if you're going to go long here with 50%. So if we're 1.5 lots short, for example, and we go long with a 0.75, when this comes down, you're going to get out of your shorts and take a loss on the longs. So you're locking in 50% of the drawdown as loss. Why not just close this out now? Why not just take that trade off? And take that one off. So what you're doing is, if you're going to hedge with this the way that you're saying here, you're just delaying the loss taking. Just take it now. There's no way out of it. You know, don't get me wrong. I know what you're trying to do. You're trying to stop taking a loss. You can't. Yeah, it's trading. If this carries on, I will be closing 20% loss, 10% loss. I don't know what I'll close, but I'll close a shed load of loss because it's totally wrong. You can't hold on and hope forever that this is coming down. You have to take loss. You can put the brakes on it by hedging, absolutely. And you could also look at something like pound odd. So go long on the pound odd, but you can't because it's doing the same thing. I'm just trying to think of something you could hedge against. So you'd look. Yeah, I don't know. Again, I mean, I've been through all of this hedging. I did this. I hedged my positions when COVID hit. So when we started to collapse in COVID, we got to a point where I went, shit, something's wrong, and I hedged the whole lot, put the brakes on in drawdown, and what it does, Swiss yen ADR, Swiss francs on the move. What it does is it buys you time basically, so you can hedge your positions and you freeze. That's it. You stop. So you're like, right, okay, let's sit back. We're not going to take any more drawdown. We're not going to make any money. We're just going to sit and we're going to watch and we're going to see what's going on. And it gives you time basically to analyze the market, look at where everything's going and make some decisions. In that time, you could get a 4-hour candle like that would have unwound 50% of your trades. What you've just done is you've locked in whatever the hedges you've put on, you've locked that in as guaranteed loss. And you still don't know if that's not going to do that. So what you end up doing with hedging is you just tie yourself up into knots. And not only are you managing a single position, you're now managing double positions because you're managing a batch of longs and a batch of shorts on everything. And it becomes so complex, you just won't be able to do it. Some people, I guess, can do it, but I can't. I just can't get my head around it because there's too much going on with everything. If you're only trading 2 or 3 instruments or 4 instruments, 5 instruments, something like that, it's not too much of a problem. When you're trading a full portfolio of everything, it just becomes too much to manage. So I've just never found a way to actually make it work. But yeah, I mean, that is an option. So if you are thinking, holy crap, look at your lot size on whatever it is and stick the lot on and just put the brakes on. When you see it starting to come down, take off those longs you've just put on, but obviously you're going to take a loss on your account. And then if it doesn't do that, you're going to need to rehedge it. So there is that option. Morning outro. How are we doing? Right. Let's have a quick look at the zone. So Aussie dollar CAD. So let's start off there. So Aussie CAD coming down. Had an exit on this yesterday. Didn't take it. It's coming down hard now. So next long is down at the lows. Exit up in propulsion. Aussie dollar Swiss, new long taken. So I need a new long on that. Gonna have to go out of time frame. See, we're down in territory we've not been in before now. There's nothing there at all that is of any use. So just going to leave it where it is. Beyond half an ADR, if it pushes down, just going to have to scale in because there's no support resistance to use at the minute. So it's just a case of scaling in. Target, again, because we're in squeezes on some of this, just moving target down to get out. If we get any kind of spike on the news, on any news. Aussie New Zealand, shorts on its way to target. Didn't quite get next entry on that one this morning, Aussie US. So that's starting to push back up. CAD Swiss, need a new long. 4 hour. Again, nothing you can do. There is no support now. We're out the lows. We've broken this area. So this is going back to September. That's the next support. So just need to scale in on the way down to support if it's going to get there. But I mean, look at the size of this move. I mean, if it doesn't do any kind of pullback off of a leg of that size, I mean, this is a parabolic. What was that in July? Can't remember what happened in July. August last year. Something happened in August last year that created that parabolic spike. I can't remember what it was. But yeah, so need a long on that one. Euro odd. New short. Buy will move up there. So again, we're out into new highs. Again, there's nothing we can do there. So get in just at distance. Euro CAD, you sell, buy, moves up. So I'm just pushing targets up basically to try and get out of some of this. Not going to go there. I'm going to go there. So obviously I will do some drawdown control anyway as soon as something actually starts to go into profit. So yeah, just above the highs. We're out into new territory with no support or resistance now on most of these. So long there, nice rejection going in on the Euro Swiss. Euro pound couldn't get in short, so I'm looking to get back in short again. Euro New Zealand, new sell. Again, don't think we've got any resistance. No, so there's no resistance. So we're out into all-time highs. Target up. So this is the previous monthly, wasn't it? I think, which we are way through now. Euro odd, next sell going in above the highs. Target to the downside. Pound odd, can't get in. Wish I hadn't have got out of that. Would have been nice, wouldn't it? Can't get in it. So I'm not even going to attempt to get into that at the moment. There's absolutely no point. I want to see this come way down. This is the area that I'd be looking at potentially, but even that, I think I'm not really interested in. I'm going to see if we can come and test this high. Really, I don't. Even that, I think, is a bit aggressive on a pullback on that. Pound CAD, again, same thing, looking for a retest to try and get in long. Pound Swiss, again, trying to get in long. Pound US, next short going in at the highs. We've got this little area here, which I was watching. But it's a little bit too close, and it looks like where we are at the moment. So if it is going to break that level, I'm looking for a retest of this area here or this area here. So this propulsion gap, basically, or these highs where we resold. So somewhere around there is target to the downs, to the upside for next short. Long, just going to move up into there. Assuming we get another position short on that, it'll be up here. That average will move up, creating that target at those highs. New Zealand CAD, longs on at the moment. Got two longs on. Not really going anywhere at the minute. New Zealand Swiss, need a new buy. Again, there's just no levels to look at. This all the way down here is your, that's miles away. So just going to try and get into something if we carry on collapsing on it, but I'm going to need to scale out of stuff before we get there. Longs, looking for New Zealand US to push up into propulsion. US dollar CAD. Oh, bloody hell. Right, so that was my entry. Top of that propulsion gap. Literally, you can't even measure it. It's not even a pip. So that wick ended less than a pip away from the low of that zone. And it's almost as if my broker went, hang on a minute, don't let him in there. We'll get out. And now it's coming down nicely. So missed that entry short. It's one of those weeks this week, isn't it? US dollar Swiss. First long on, second long entry at the lows. That's going to trigger in a minute. Just going to move the target down into propulsion because that entry there is going to trigger with a new entry, which is going to bring the average down. So that will be a profit. So that will be exit to the upside, assuming that we get some kind of strength on the Swiss franc, on the US dollar. That's it. So yeah, just waiting for something to kick in basically today that is going to drive some strength into these Australasian pairs. Euro odd weekly range already hit. So there's your weekly range hit. Just gone in. We've got 4 of them. Look. So CAD yen already done its weekly range. So we're on Tuesday. So that's the entire weekly range of the CAD yen already been done. It's already starting to come off it. We've got the euro odd weekly range already in. Again, absolutely parabolic this. I'm not quite sure why this euro is so strong, considering they're going to have to foot the bill for Ukraine. But anyway, so again, euro. So that's just come up into resistance. There we go. So there's a reaction at that previous high we've just got. So the sellers are stepping in here. That quadruple top basically being popped straight into that area. So hopefully that will kickstart that move to the downside. God, my average is 175 ADR. Bloody hell. It's going to take a hell of a move down, isn't it? We need some really bad news from the Eurozone. So yeah, that's hit the resistance there, but that's done its weekly range already. Euro CAD and pound CAD. So again, Canadian dollar weekly range already done literally in 24 hours. So yesterday, super parabolic moves, but not a lot we can do with them at the minute. Stopped out, unfortunately, on that. So that was sitting at just over $1,000 in profit 10 minutes ago. Annoying. Anyway, letting that play out. I've found a problem with this as well. This ORB V2, the way that it's calculating the lot sizes is not working properly. It is working properly, actually. It's working exactly as it should do in the logic, but it's not how I anticipated it working, how I want it to work. So I need to redo this logic, because it's the lot sizing that's being used isn't based on last closed trade. It's based on last closed trade per instrument, which isn't right, because we're taking too much risk on stuff when we shouldn't be taking a lot of risk. So it definitely needs some work on that. And again, just trying to find some time to get into it, basically. I bet Elon is slightly regretting his political career now. Tesla share price, yeah. I mean, Tesla's been absolutely killed, isn't it? What's Tesla in? Is it in NASDAQ? Yeah, I mean, absolutely. Bye, Elon. Yeah, awful. 100 billion, isn't it? 100 million? I don't know. He's lost a lot of his wealth. So yeah, I mean, that's not helping the stock market, obviously, at the moment, especially in NAS. Yeah, one of the Super 7 on the way down. Which brings us nicely on to long-only stock index strategies. This is the time when they will be struggling. So anybody that's using long-only strategies on indices at the moment isn't going to be having too much fun. Let's look at the daily. There we go. So we're in a dip. We've definitely hit a high here, haven't we? For the last 3 months, look. So December, January, February, 3 months of stagnation. So we'll look at a way to maximize that using the position trader EA. Let me just catch up on the chat before we go into that. On August, I was in the same position. Same exact squeeze happened in August. Also, it corresponded with the US stocks huge drop, which the Dow Jones dropped by 1,000 pips on opening, and the Nikkei sank as well. Yeah, so yeah, I mean they are correlated. Yes, definitely, but it doesn't help you. Correlation is good to understand, but absolutely useless from a trading perspective. There's no way you can use correlation in trading apart from limiting risk. Yeah, so Aussie dollar So Euro odd and Euro New Zealand are correlated in the fact that when one goes up, the other one goes up. That doesn't help you in any way, shape, or form. If you see the Euro odd going up, you can't go, oh, I'll go long Euro New Zealand, because it's already happened. If you see the Australian and New Zealand dollar currencies tanking, you can't go, oh, I better short the stock market, because it's already shorted. Yeah, do you see what I mean? Correlation means that things are moving at the same time. So therefore, if you've seen something happen, it has happened on the other thing. You can't take advantage of correlation in that respect. It's useful for not over leveraging. That's the only real use for it. But yeah, so yeah, if you're finding there's things that are correlated, it just means if you know that they're going to move at the same time, you're basically, if you take the same trade on both of them, you're doubling your risk. As long as you're reducing your risk down, that's not a problem. Because there's no problem trading both. They are going to move independently. If you look at the Euro odd, let's open a Euro odd, and let's open a Euro New Zealand. Yeah. So you got virtually, I mean, it's not the same. Yeah. See, this moved a little bit faster towards the end of that month, whereas it actually dropped that month on the Euro New Zealand. So the Australian dollar did worse than the New Zealand dollar at the end of January. But, you know, we made a new high there. We didn't there. So, but overall, you're going to get the same thing. So if you're going to trade the Euro New Zealand and the Euro odd, reduce by 50%, or make sure that your lot size is small enough to trade everything. But obviously keep the risk small, because when things move together, they're going to get squeezed together, aren't they? Still going, that. Right. So let's look at this S&P correlation. So what I've done is I've set up the position trade at EA to trade. We're going to look at different stock indexes, basically. But I've set it up with just a 10 grand account, long only. So we're not going to take any short positions at all, because stock indices are designed to go up. So if we look at the S&P 500, historically, yeah, this is going back to, so there's COVID there. The S&P 500, bear market aside, the vast majority of the time just goes up. Yeah. So you get the odd bear market, and it tends to be somewhere between 1 to 3 months, typically a bear market. Once they're over, basically, the bear markets, obviously then we get this big, nice rally. And you tend to find that things move in quarterly cycles with stock indices. So you tend to get a quarter of not such good. And there you go, there's one. That's 1 month, 2 months, 3 months down. So about a quarter where it's not good, moves up. Got a month bad there, pushes up for 3 months. You got 1 month, 2 months to recover, and then a little down dip, and then a move again. So things tend to move in quarterly cycles. So this strategy that I've been talking about, and I talked about a little bit yesterday, is basically what Warren Buffett does. Obviously, Warren Buffett, biggest, richest investor in the planet. All he does is he buys dips in the S&P 500. So he's buying the dips in the stock market, waiting for the stock market to rally. So all that it's doing is excluding this bear market and excluding COVID. Obviously, there's not a lot you can do with those. He's riding the months where we don't actually have any bull price action, i.e. we have either a down month where we're ending bearish, or we have some kind of spinning top doji style month followed by maybe another spinning top doji style month. He's just riding these and scaling into positions, waiting for the rally to continue. So the reason stock markets go up is because they are manufactured to increase share price. So all businesses, this is the S&P 500, for example, but they're all the same. We've got 500 companies here, and all of these are the top 500 companies in the US. So these 500 companies are doing well. When you're not doing well, you start to drop down the rankings. Tesla, yeah, not going to be in the top, well, they probably are still in the top 10, but actually that'd be interesting to look at quickly. They're number 8. So they're out the top 7. Costco have overtaken Tesla. Oh, there's got to be a meme in that. So yeah, these guys obviously are dropping down. Yeah, 2.84 down, blah blah blah. So it's just they're dropping down. When if Tesla was to continue to drop, it would fall out the bottom of the Nasdaq 100, top 100 tech stocks. It would fall out the bottom here. It's a long drop. It's not likely to happen, but if it did, these guys would jump up and take their place because they are doing well. So within stock market indexes, all they're doing is plotting how well economically the top businesses are doing in the US, or the top 100 tech stocks are doing in the US, or the top 100 companies in the FTSE in the UK are doing, how the top 40 companies in Germany are doing, the DAX. Yeah, so they're plotting what the overall stock price, if you like, and success of those companies is. Meaning that if a company doesn't do well, one of two things will happen. Their board members will replace the board members who are cocking it up, change the direction of the company so that it makes money and they get paid, or it will be in some kind of catastrophic problem where it cannot recover. Peloton, yeah. Peloton had the biggest ever year of their life, or 2 years of their life after COVID, because we couldn't go to the gym, so all we did was buy home workout equipment. Peloton's share price collapsed when we got back to the gym because all they did was flood the market with secondhand bikes. They couldn't sell any new, and everything collapsed. Yeah. So as Peloton died, someone else rose up the ranks and replaced them. So stock markets will continuously go up. This is currently trading at 58.56. In a decade's time, if you come back and watch this video, you'll be trading at somewhere in the region of 8,000, 10,000, 12,000, not sure what, but the price will have gone up because inflation drives up monetary value and makes shares more expensive. So as long as companies are performing as normal, by default, their price will go up. So that's basically what stock indexes do, which is why they say if you buy on January the 1st, the S&P 500, by the time you get to the end of the year, on average, you will be up 8% because stock indices generally rise by somewhere on the region of 8% a year, which means that this will be 8% higher next year, 8% higher the year after that. And as it compounds, it gets faster and faster and faster. So it makes sense then that you don't short the stock market if you want to hold it long term, and this is kind of an investment strategy. However, you can do this on lower time frames to get in and out of the market and magnify that 8% on average that they make to make it much, much larger. And the way that you do it is, instead of buying once at the beginning of January and selling at the end of December, you buy once at the beginning of January and then you keep buying if it goes down, and then you wait for it to go up, and you generate somewhere around about 3 to 5% profit on that trade, and then you wait for it to come down and rinse and repeat. If you can do that twice a year, you've made 10%, which is outperformed the stock market. If you can do that 3 times a year, you'll make 15%. If you can do it 4 times a year, you'll make 20%. So your goal is to try and get in and out of the stock market more than once, because that is just going to exponentially increase the amount of money that you make out of the stock market. So all you've got to do is try and get in to more trades as often as possible. So the way to do that is to find more dips. So again, I'm not going to look at this bear market here because this is an anomaly, and there is always a way out of this, but you would have to adjust the strategy in a bear market, because when you go down and you realize that it's not working, you've got to get yourself back out again, break even, not take any money, and then try again. Didn't work out, get out with a loss or break even and try again. And this is the year where you wouldn't have made any money using this strategy. But this is the first bear market for 12 months we've had, full stop. Never happened before. So the longest bear market you get, really 3 to 6 months maximum. We don't have a year's bear market. This was caused by the COVID run up, which was exponentially larger than it should have been, because businesses were actually making losses during this time, but their stock prices went up. Can't sustain that, so it had to collapse. So in normal conditions, like we are at the moment, that's what's going to happen. Yeah, this is what just generally goes on. So the best way to do this is to drop down a time frame. So if you try this on the daily time frame, we can try this on the daily, we can try it on the 4 hourly, you can try it on lower time frames, but then you're just taking a large risk. So bear in mind your average hold time in a bear rally is going to be 3 months. As long as you can survive 3 months, you'll be all right. But surviving 3 months is going to cost you a lot of money, because the swap cost to go long is very expensive. On the S&P and most indices, you're looking at somewhere between $5 to $10 hold. So if you're taking a standard lot long, you're going to be paying $10 a lot to hold the thing. So you've got to try and balance the costs of trading it with the time frames that are going to get you in and make you money. So what I've done initially is I've set up the so that's a theory basically. I've set up the position trader EA to take RSI mean reversion entries. I'm starting off with 1% risk over 1 ADR, so it's going in fairly high risk. We're only trading one instrument here, so we're just trading the S&P. I'm using a tiny little lot multiplier of 1.1. Doesn't really make any difference. You don't need it. Let's get rid of it. Distance between the trades I've set at 1 ADR. So what we're saying is, in these bear markets, I'm going to get into a trade. I'm going to wait for it to move the average daily range beyond before I look at taking another trade. So if we drop for a month, we're probably not going to drop more than 4, 5, 6 ADR. So I shouldn't be getting into more than 5 or 6 trades a month. That's the theory. Which means that in a standard bear rally, you shouldn't get into more than 10 to 15 trades, absolute maximum. But again, these are things you can fine tune. So we're just starting off with getting in, and then we'll see. Obviously, you can run optimizations on this to see what is the best to do. ADR exits, I'm going with 3 ADR. So obviously the idea here is we're scaling into these dips. Yeah, so I'm saying, right, I want to get 3 ADR of profit. Now, the more trades you have on, the more money you're going to make. So if you get into a single trade, i.e. the price comes down, you get into a single trade and it goes up 3 ADR, you're not going to make a huge amount of money. You're going to make 3%. If you get 3 ADR above average movement after you've scaled into 5 positions, that profit is going to be exponentially larger. So it's actually more beneficial. We don't want to just get in and get out, get in and get out. Obviously, that's lovely because there's hardly any drawdown in it, but also there's not an awful lot of profit in it. If you do that 8 times a year, you're going to make roughly 24%, which is fine, but you could make a lot more than that. And you'll see that as we go through. So I'm going to start the test from 1st of December. Let's start it from 2023. And we'll run it for 2 years, basically. So we're using a 3% target. I don't know whether that's good or bad. 3 ADR target. There's no drawdown control being done. Again, there's options for drawdown control. There's all sorts of options in there. I'm using a 4-hour RSI 10 for entries and a 15-minute signal candle. So the 15-minute signal is either going to be a 3-bar reversal, a reversal alert, or I'm going to get rid of the moving average cross actually. Where are we? Signals. There. I'm going to get rid of the moving average cross. I'm just going to go with reversal alerts on it. So good signs of strength, confirmation of strength, basically. So the sellers hopefully are over. So it's either going to start with a 3-bar reversal or we're going to get a reversal of that. So let's just run this and just make sure that it's working. I'm just going to have to regenerate data. Gutted. Exactly what happened yesterday, wasn't it? Stopped out on that one as well. Look. Ugh. Terrible today. See, watch that. That was far too big, that trade. 41 lots, look, twice. Too big. Didn't need to take 41 lots because the last trade yesterday was a loser. It should be taking a 20, not a 40. So it's taking the wrong lot sizing, which is skewing these results. I covered this before. This needs work. Got to do some more work on that, which I will do. Right, so we're off. So we've got first entry. Oh no, didn't quite get in because the RSI. Oh, sorry, we're not taking shorts anyway. We're taking longs only, aren't we? Ignore that. Right. So let's wait for RSI. Let's wait for a pullback. There we go. So we got a first long on there on a 4-hour RSI extension. So you can see that the next entry there is going to be 1 ADR apart. There you go. There's your second entry. Third. Now we're off. Not back in a bull market yet. Fourth. So we're waiting for that 3 ADR push before we get out, and then we rinse, repeat, try again. 3 ADR is quite a long way. There we go. So there's your 3 ADR exit. Can't zoom out any more than that, but you see, so we took 4 trades there. Let's put period separators in so we can see how long these are taking. So from a day's perspective, from first trade, which was there, we are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. About a month and a bit. Yeah, so that's the average hold time. Yeah, so we don't forget, we're trying to get in more than once a year. So we've just got in, on average, 8% return we're going to get on the S&P. If we can get in 3 times a year, and on that trade there, we made 6%. Yeah, so we made 6.6% on that trade. Yeah, so average return on the S&P is 8%. So first trade in out 6%. We've almost outperformed the S&P in one trade there. So let it run again. Obviously, this is a long-term strategy. It's not something that you're going to be able to rely on as an income. Well, depending on what you put into it. But this is what I used to do with my pension. This was my pension fund strategy, basically, before COVID. So there you go, second trade. So let me just show you the difference there. So we made 662 on a 10 grand account on our first trade. That second trade has made us 260 there. So you see, you made 2.6% on that one single. So a single trade entry is going to make you roughly 2.5%. So if you get 3 single trades a year, you're pretty much performing the same as the S&P. Yeah, but it's all about surviving the S&P squeezes. So I need to have the P&L showing on this, really, don't I? Can't really do that because I haven't got it. So there's another entry long. So 4 days of solid drop, out again, another 2.5% in the bank. So we're now up to 10%, 11% gain. Single entry, second entry, third entry, fourth entry. Be easier doing this actually on a 4-hour chart so we can see the weekly separators basically. But so stock market again sideways at the moment. We're not necessarily in a bull month. We're not necessarily in, looks like we're in a bear month this month. So there's your first bear month gone. Still in a bear month. Bear in mind, there's no lot multiplication at all here. Again, if you wanted to be more aggressive, you can lot multiply, but I wouldn't do that on 15-minute charts. If you're going to get aggressive, you want to be spacing your entries out a bit further apart. This might actually be a little bit aggressive as well. But you see, we're not actually far away from average at any point. There we go. So another exit there. Now we're up to 12. So that's up 27%. We are now in November. Okay, so we've nearly done a year. Hang on, let's stop. Well, it's December. Right, so this is a year. There we go. So that's the end of the year, 26th of December. So we've been running for 1 year. We've done a 27% return. Yeah, remember what I said? 8 times 3. If you can get in 3 times a year, you're going to make 24% a year. That's basically it. So this way outstrips any pension fund or investment fund, or in fact just Standard & Poor's S&P 500 performance. Yeah, not difficult. We're not taking tons and tons of trades. We're just waiting for the market to dip, stock prices to drop ahead of earnings typically, and then rally. And that's all we're doing. And we're just scaling in. But this drawdown doesn't come into the equation here. And this is the way that the pension funds, not so much hedge funds, but the investment funds and pension funds operate. Drawing down 30, 40% into your account overall isn't unacceptable. It's normally what they do, because what they're doing is they're using the capital to invest into businesses which are guaranteed to return a profit, the S&P 500. And if they don't return a profit, they will be removed from the S&P 500 and replaced with something that works. So this is the whole idea of this strategy, and that's what Warren Buffett's investment strategy is all based on. He is investing in the companies that are performing. If companies aren't performing, they are automatically removed from his portfolio because he's investing in the S&P 500. So it only contains companies that perform. Therefore, it will only perform. Yeah. Apart from when we get uneconomic situations, potentially this year with Trump, you never know, unfavorable conditions for global economics. COVID. I mean, this is an unprecedented thing, COVID. And the S&P did not perform. No one performed during COVID. COVID shut the entire world. You can't do business when you're shut. End of story. That's it. So the fallout we had was a bear market for over a year while the market recovered from the bull rally that it shouldn't have had because businesses weren't performing. However, stock markets carried on rallying because they just did. We don't quite understand why. Well, I don't understand why anyway. But so there we go. Up 28% first year. So this is just using 4-hour RSI extensions, okay? So you can also look at hourly RSI extensions. You can look at spacing this out. You can look at lot multiplication. You can look at larger targets. You can look at a buy and a hold strategy, which is time-based and will get you out after 3 months. Yeah, there's all sorts of ways that you can do this. But the important thing to sort of understand from this strategy is it is a long-term investment strategy. So if you had 100 grand to put in the bank, that's what you use it for. Yeah. So you don't do a pension, you do your own pension. And that's what I have done in the past, is grow my capital using this effect, basically using this approach. It's riskier than investing in the S&P 500, riskier than having a pension fund do this for you. However, it's not actually very risky when you look at the size of the trades that we're taking, the holds that we have. The only danger is a bear market. So we've run this in a bull market. We've seen the returns in a standard year. We'll let this one run out quickly. Okay, so there's another one. So we're up now 43.9%. And then we'll run this over the bear market to see what impact that bear market had on the strategy. And this is where you need to fine tune. There's a lovely trade. Look, in and out in 2 weeks. That's very nice. Up 70% now. Sorry, that was a trade that didn't log in there. 58% was that last one. Now we're up to 70. This doesn't catch up. Sometimes you have to slow it down because it doesn't update the graph and update the results instantly. So there's a 2 trade, 3 trade, 4 trade. And again, you can use the position trader EA's export functionality to export a daily report in Excel, which will tell you the exact drawdown that it's in, how many trades it's in, the total lot size it's in, and you can extrapolate hold times and all sorts of stuff. And that's why I've got that export functionality in the EA, so that you can get the data out for analysis and you can analyze and see what worst case scenario drawdown was. Obviously, if you use this with a fixed lot size entry rather than a percentage entry, you'll then be able to see what size account you need to generate what returns. So there you go. There's another one in and out. Let's see if that's, not sure if that's updated again. So we're now up 117%. We're in September 24 now, so we're coming towards the end of year 2. We've doubled the account. Yep. So think of your pension fund. I don't know how much you've got in a pension fund, but whatever you've got in a pension fund, imagine doing this for 5 years and then imagine your retirement. Totally different kettle of fish. I know what my pension fund is with the pension that I've got, and I know what my pension fund account did. A lot different. Yeah, it's just not, you're never going to get the same performance with somebody that's taking a huge cut. Same as the banks, yeah? The banks are earning on the money that you put into a savings account, they're quadrupling it every couple of months. They're paying you 3% interest. Yeah, if you actually have capital to use to make money with, it's actually very easy to do, but you've got to have capital to do this. Look at that. Oof. Something went very, very wrong there. December last year. What happened there? Was that Trump? Oh, it was Trump getting in, wasn't it? Yeah, there you go. This was the Trump effect. So let's just see if we close this one out by, I don't think we're going to close it out at target. So this one's probably going to close out wherever it will close out. There we go. So it just closed out there. So we ended up 24.3. So that's 143% return in 2 years. And that is basically it. That's the strategy in a nutshell. Yeah. So you can do lots of variations on this. So the H4M15 variation is the variation that I ran. So this is the exact, pretty much the exact set file that I used. No lot multiplication. I was using single ADR spacing. In fact, I was using 1.5 ADR spacing towards the end. And yeah, that is it. That is all it does. So let's quickly run this over the bear market. So let's go worst case scenario, which is going to be the 1st of January 2022. And we'll run it until, let's just run it for the whole year. We'll go to 2023. So this is the bear market. So now what we're doing is we're testing the same strategy here in our bear market. Really wish I could work out how to turn those, stop those lights turning off. Yeah, we'll run it in visual mode. What I'll do is I'll quickly stick it up on the 30-minute time frame. It's not going to make a lot of difference, but it just will run a bit quicker. Okay, so there's our first few entries gone in. There's 3 entries just gone in, out. First, second, third, fourth, fifth, 5, 6, 7. Okay, what I want you to watch is how often we get back to break even. Okay, exit opportunity. Got out anyway. But even in a bear market, the bear market goes like this. Okay. Every single one of these is going to be hard to make you the return that you need, but it's not going to be hard to exit you. Okay. What you're going to do is you're going to lose trading costs. It's going to be costing you because longing it is expensive. And the hold time is going to be a lot longer, because obviously what we're expecting is this, and we're buying here, 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 and waiting for the pop. What we're doing in a bear market is we're buying here, 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 and we are not getting the pop. We are getting an exit, but the exit, as you can see, is not as good. However, during that bear market, look at the hold time. So we had one, can't see it. There's one here. So there's a trade here. 1, 2, 3. So we only had 3 trades that year, and we were in our 4th. Okay. So compare this equity curve in a bear market to the equity curve in a bull market. What we've actually managed to do is return 32% net gain on something that ended in a loss. So it did not make our 8% profit. It actually made a loss of more than 8%. We still managed to gain 32% on our account. But the drawdown in here would have been fairly hefty. Not actually that bad, actually, if you look at it. 1, 2, 3, 4, 5, 6, 7. Okay. So it works in a bull market and a bear market, but it's not something you can rely on specifically to make regular income in. It's an investment vehicle. You can try it on the other indices. The S&P 500 is typically the most, I'm just going to run this quickly on others to show you. Let's just go up to date now. And I won't run it in visual mode. I'll run it in normal mode so that we can just see it faster. Yeah, so it's something that obviously the S&P 500 is the instrument of choice because it's the densest, because you've got 500 stocks available to you. The volatility within those 500 stocks is a lot smaller. So if you think you've got 500 things smoothing out an equity curve, if you only had 5 things smoothing out an equity curve, something like Tesla collapsing would make an exponential drop. When you've got 500 stocks, if Microsoft has an exponential drop, there's 499 other stocks going, yeah, whatever. Yeah, so it keeps it stable and it keeps the volatility low. So things like the DAX and the FTSE and the NASDAQ, where you've got less than 20% of the stocks available to keep that stable market condition, you're going to get more volatility, more risk. However, you will probably get more movement, which means more entries, which means potential more profit as well. So you need to do your back testing with each of the other indices. I only ran this on the S&P 500. I didn't run it on any other stocks. So it will work, but if you look at things, let me just move that down a minute. If you look at the S&P 500 and then we replace that chart with the DAX, haven't got as much data, but you see how more stagnation there is on the DAX, where we have more periods of sideways on the DAX, and there's more sustained periods of selling. I mean, at the moment it's still going parabolic. You look at something like the haven't got the FTSE, but the NASDAQ. NASDAQ is fairly comparable to the S&P. The Dow, which has only got 30 stocks in it, you get a lot more sideways movement and stagnation in as well. So the upshot is the lower the number of stocks, the less, not reliable, but the less smooth, if you like, your equity curve will become. So yes, as FT Nets just said, the Russell 2000 might be a good alternative. I haven't got the Russell. I don't think. No, I haven't got the Russell. The problem with the Russell 2000 is the Russell 2000 includes an awful lot of small cap, low volatile stocks, high volatile stocks rather. So because the Russell 2000 has got small businesses in it, small, I say small, multi-million pound turnover businesses, but not large corporates. There's a lot more volatility in there. They win or lose a contract, it can make their share price drop $100. Which means that there is also an awful lot more movement within the index. So you'd have to check that Let me just see if I got the Russell here. There you go. I got the Russell there. Yeah. So this is only this is going back to COVID. So this is 2020. So this is the 2021 bear market. Look at the size of that bear market compared to the rally. It virtually undid 100% of the move, and then it stagnated for a year and a half. And the lovely bull run that we're in at the moment, it's not, is it? But also look at what it's doing. That would have just about been an exit. That would have been an exit. But every single one of these drops gives you an exit, which is more than 3 ADR. So I think you'll find if you run the same strategy on this index, you will probably find it will work. However, I'm not sure if it would be as effective. So you'd have to try it. You also need to bear in mind, I don't know what the swap costs are to hold the Russell. 667. So it's not much different to the rest. 667, 490, 665, 678. Yeah, so I mean it's not a lot of different, to be honest. So they're roughly the same costs for doing business. So yeah, let's just quickly look at what the result of that was. So this was the Nasdaq 2-year run. We generated 116%. So it didn't perform as well. We got 150 odd % out of the S&P, but at the end of the day, profit factor of 31.56. We only took 32 trades. Strike rate 90%. Drawdown 6,334. So your maximal drawdown is showing at 35%. But bear in mind, this is a 10K account. If the very first trade you took went south, you would have drawn down by 63% of your account. Yeah, so just bear that in mind. It is not a strategy where you look at it and go, I got to stay within X. Whatever you put in there is what you put in there. You may have to top it up, but you will get out because it is an index. So it's something that isn't fun to watch. It's not something you look at. I trained myself to look at it bi-weekly. I had it running on a VPS, actually. It was a cloud VPS I had it running on. And I trained myself to log in and look at it bi-weekly because when you look at it on a day-by-day basis, it's a little bit like weighing yourself. Yeah, if you've ever been on a diet and weighing yourself, if you weigh yourself every day, you will drive yourself nuts because your weight goes up and down and up and down and up and down, and then you'll have 3 days where it will go up for 3 days in a row, and you'll be like, "Crap, I need to eat chocolate because I'm depressed." If you look at your weight every week at the same time every week, you will have a gradual drop in your weight because your body fluctuates intraday. The market fluctuates intraday. So if you look at this every day and you go, I'm in 1 trade, then the next day I'm in 2 trades, then the next day I'm in 3 trades, you start to panic, which makes you watch it closer, which makes you panic more. When you get back to break even, you close it out and you forget the back test. Yeah, but the back test is 2 years returning 130% or something. So do not look at it every day. Look at it every 2 weeks, every 3 weeks. Look at it 10 to 15 times a year because it's that type of strategy. It's not something you need to be keeping a very close eye on. Check the servers up, obviously. But also this is something you can do manually. So you can very easily use, just a normal lot. You get in with a lot size, and then you just draw a line 1 ADR away from wherever your last trade was. So that's your first trade. And you draw a line here and you go pending order. And if you wanted to, you could just set pending orders in the market in a grid of 1 ADR and it will work. It's better to wait for bullish price action. So wait for a 3-bar reversal, wait for a reversal alert to kick into the market and then take a trade. But that's basically what it does. So there's other variations on this that I ran as well. So this is using the 4-hour time frame to buy the dips. Daily time frame to buy the dips, not quite as good. You might think, oh, that's probably better. But if you look at the RSI on the daily time frame and how often you get extended, and then you look at the 4-hour time frame and how often you get extended, you don't get as many extensions here. You had one extension that month. On the 4-hour, you may have well had one there. Probably didn't have one there actually in this case, but you definitely would have had there. But you'll find that the difference between the 4-hour and the daily doesn't quite get into as many. Now, the next variant of this is running the hourly time frame, and this is what I started to do before COVID. So dropping down to a 1 hour. This is using the 10 RSI, by the way. You can use a 14. Doesn't make a massive amount of difference. But on an hourly time frame, obviously you don't want it to be quite as aggressive. But so if you drop down onto an hourly time frame, and then you'd need to definitely drop down onto a 15 and do the same thing, what you're going to do is you're going to get in a hell of a lot more trades. The problem is you're going to get in and you're not necessarily going to get that 3 ADR move in your favor, which gets you out of the trade. So you tend to go into more stagnation and longer trades with more positions in for longer periods of time, building up more size so that when those 3 ADR moves come, you actually make more money, but the drawdown is exponentially larger. In fact, this might even blow the account with because I'm using a 1% risk here, obviously on initial trade. So this is quite aggressive. But we'll see. There you go. We're up 20% already. We're stuck in a trade because it's not taking any trades. So I know we're getting stuck in something here. And this might be where it falls over. No, it's okay. Up 39%. Up 57. We're 1 year in. So first year, 57% return. 66. Into April in another trade, 77, 97. We're halfway through the year. So we've done 50% in half a year. Last time we did 50% in an entire year. Coming towards the end of the test now. A lot of trades just gone on there. This is obviously post bear market. So this is kind of normal market conditions. 245. Oh, we haven't finished yet. Wow. That's a lot more profit. A lot more profit. So the 145% return so far. 163. 169. We might end up with open trades, so we might get a dip at the end. Oh, no, we didn't. That's good. So 172. So 172% return over 2 years. 40 trades taken. Strike rate 92. Drawdown 11,231. Okay, so your original balance of 10K, it actually drew down 11.2K. So obviously we had profit and it drew down by 11K after we'd made profit. If we'd have opened up with that 10K and gone straight into the move that caused that drawdown, the account would have blown. Yeah. So the lower the time frame you go, the higher the risk, because the weaker the entry signal. Yeah. The condition in the market we're requiring is only an hour's worth of drops, whereas 4 hours worth of drops means that we're looking for a good intra-week drop. This could be an intraday drop. So you're getting in at the very top of the pullback rather than halfway or into the pullback, yeah, in the trend. So again, this is kind of my findings that I had before, which is why I settled on the 4 hour entry rather than the one. So That's it. 70-30, I just kept a standard. Again, you can fine tune this. You could use 80-20, you could use 60-40. There's not really any right or wrong. It's just going to give you different entries. But at the end of the day, as long as and the key to this strategy is remembering that as long as the stock market goes up, the strategy works. When the stock market goes down, it still works. It's just not as effective. If you get a collapse in the stock market for some reason, like COVID collapse, you're probably going to blow the account. Yeah. Pension funds went out of business. Yeah. Hedge funds lost fortunes and took a long time to recover from them. Banks and institutions lost a lot of money. Yeah. You are a bank. This is a banking strategy. If the banks are in trouble, you are in trouble. If there's a war and it collapses the stock markets, you are in trouble with the banks and the rest of the world. Yeah. So don't be under an illusion that this is anything clever. It's just an investment strategy. So, but it works. Just let the trade play out. Aussie, New Zealand, Aussie, massive day extended, likely pull back sooner or later. Yeah. Do I still do this in my pension account? No. And one of the reasons I'm looking at it again today, to be honest, is because I'm thinking about restarting it. So I did this. If you go back to the streams before COVID, which I don't think you can do because they were on whatever it was I was using at the time. It wasn't YouTube. I only started streaming post-COVID, I think, on YouTube. The prior to that, I was streaming in Telegram on not Skype, whatever the other one is. God, can't get back. Why can't you scroll back any? Can you not sort these by date? There's no sort, is there? Oldest. There we go. Ding. 21. There you go. So that 17th of December 21 is when I started streaming on YouTube. Prior to that was over the pre-COVID, post-COVID era. And I was running the strategy pre-COVID, and then I stopped running the strategy I might have been running it at the beginning here. Kind of need to watch some of them really to figure it out, but I can't quite remember timings. I'd have to have a look at the accounts, but it was somewhere around here. Off the top of my head, I'm struggling to remember, to be honest, but it was somewhere around here that I when we put in a new low after an accumulation, I got the wind that something wasn't right, and everybody did. Everyone was like, there was talk of going into a bear market, all this sort of stuff. We put in a lower high and a lower low, and I think that's somewhere around here I got out and I stopped and I paused the account because I'd made a loss. So I made a loss on a trade because it had struggled for months to generate decent revenue. So I stopped it. And then we went into this. And if you look back at some of the live streams from 2023, it will be. I was saying when we break back above this high, this is when I will consider getting back into the strategy. And this was when I was looking to turn it back on. We had a bull month, and then we had a mediocre month. Then we had a bull month, and then we had a bear month. And I was like, not quite back into a bull market. So I was waiting for a bull market to reestablish, and it didn't happen. So I didn't turn it back on. I think now we've reestablished a bull market. However, we've just had Trump come in. So for me, this is exactly where I think I want to start buying stock indices again. Because I think Trump is going to make America great again financially, but he's just not doing it at the moment. So I think the markets will start to get back into normality again. And this is why I'm re-looking at it now and why we're doing this stream today, because I've mentioned it a couple of times. and somebody wanted to go into it in detail, so we are. But from here, you need to look at a 3-month drop, and that's what you need to factor in as really what worst case scenario I think is going to be. So this is part of our bear market moves. From here on, I think we will probably be okay. So I'm considering restarting it, although it would be with a smaller value. So I might start it with something like 25, 30K, and see how it performs, and then sort of ramp it up from there. But this is a sort of account and the sort of strategy as well, which is fantastic for things like holiday funds. So if you stick 10 grand into this account, within 12 months, with high probability, you'll be able to take your family on a 6-7 grand holiday. Yeah, that type of account is what you would use this for. Paying off the mortgage type account. Yeah, doubling, halving the time that your mortgage is going to take to pay off. This is that type of thing. If you pay off 10 grand on your mortgage right now, yes, it's brilliant because it reduces the time in your mortgage. If you put 10K into this account and pay off 20 grand's worth of it next year, it actually reduces the speed of your mortgage, or the time of your mortgage, twice as quick, that sort of stuff. So this is that type of strategy, but it's not something really you can use comfortably to generate regular payable income, because you will have periods where it's just not going to make any money. So, you know, looking at some of these, yeah, I mean, this period, I can't zoom out anymore, but from the 22nd of August to the 30th of November, August, September, October, November, there's that magic 3-month cycle. You didn't do any withdrawals, and it took that long to move 3 ADR above your average price. And again, you know, this is one variation on the strategy. Have a look at just making 1 ADR. Have a look at using lot multipliers. I wouldn't use lot multipliers. I really wouldn't use lot multipliers. You don't need to. It's going up. You don't need to worry about that. It will go up. Even when it's pulling back, it's going to go up. So lot multipliers are going to make it a lot more aggressive and make a lot more money. But let's look at exiting with 1 ADR instead of 2 ADR, 3 ADR. So we're going to be in and out with much quicker scalpy type movements. You're going to get in roughly the same trades, because when it's pulling back, you're going to get in, but you're just going to get out faster. You're going to get out there instead of up here. So when it does this for 3 weeks, you'll be out, and you might be able to get in again. Rather than sitting there waiting 3 months to get there, you could have been out here. That might have been the exit. I don't know what difference between 1 and 3 ADR is, because I don't know what ADR was back then. But yeah, I mean, you can see it's going to do roughly the same thing, but your return on investment is going to be smaller because you're targeting less. So we're up 17% now in a year. Yeah, so we were up 60-70% in a year because we targeted a much bigger return, didn't we? So we're up 24% now. Yeah, so now we're at 1 year in, we're up 24. So we've only made 24%. Crap, we've only outperformed the S&P by 3-fold. Yeah, so it's, you know, it's a fantastic strategy, but this is Warren Buffett. This is what he does. Not a secret. Been around for a long time. Any questions? Go and test it yourself. Obviously, verify the results. Position Trader EA is all you need to do it, or Market Reverse Alerts EA will do it. So it's literally, we're just scaling in on 4-hour RSI extensions, but only going in the way the market is going. It's one of the very few things out there you can turn around and say 90% sure that's going to be up this year. That's going to be up this month. That's going to be up this quarter. There's very few times you'll turn around and get that wrong. FX, gold, oil, any commodity, any futures market, any individual stock, you can't say that. Stock indices, pretty much with certainty you can. But it's just a way to exploit that edge. It is an edge. The edge is knowing the direction, which is where obviously it would fail. if for any reason the stock market suddenly decided to collapse. But that is an economic collapse. It's the end of the world, isn't it? This drives the world. Money drives the world. Money drives economics. Economics drives life. This is the life force that makes everything on the planet work. If this doesn't go up, we've got a massive, massive problem. So, you know, if you lose 10 grand in an account because this has gone down, that's the least of your problems, isn't it? Let's face it. So, just see, there we go, that's finished. So we made 69% return with a 1 ADR target. Drawdown 4.7 instead of 11.2. So a third less money made, a third less drawdown. It's not really rocket science, is it? 90% strike rate. So you can actually improve that strike rate to 100% if you targeted maybe 5 ADR. Let's, for fun, no, let's not, because that'll blow the account. I was going to say, let's go with a martingale multiplier of 2 and go for a 5 ADR target. It wouldn't survive. I'm just going to run this quickly on open prices because you're going to get roughly the same results on open prices as you will on control points with this type of strategy, because it's such a long term. Accuracy is not important, is it? Just want to see what that would do using a 5 ADR. 7 grand drawdown, 96% strike rate. So 25 out of 26 trades successful. Net profit 171%. Pretty good. There we go. And not a lot of drawdown. But you're not taking many trades either. 26 trades in 2 years. Yeah, so you're not going to get in very often because it doesn't pull back very often, does it? That's the whole point. It goes up. There we go. That's the end of that. So that is the strategy in detail. There we go. So that's what I've been doing in the past, and that's what you can do now if you want to. Hi, Joe. Nice avatar. New here. We'll rewind. Bad start to the morning. Dropped phone in the toilet. That's not a good start. Why were you in the toilet with your phone? Inquiring minds want to know. I don't think I want to know. I don't answer that. I don't want to know. No, I don't want to know. I've very nearly done that actually myself. Fussy, yeah. Anywho, right, what's going on with these stock indices this morning? Not a good start to the morning. Hopefully we get a better afternoon. Pound CAD coming down. US dollar CAD ADR. US dollar Swiss ADR. Bye-bye US dollar. Swiss franc. Oh no, this is US dollar. Going on with the Swiss. Okay, Aussie dollar Swiss is pulling off of ADR. Aussie US bull. 3-bar reversal. How long we got left? 15 minutes left on this 4-hour candle. There is a beautiful 3-bar reversal at last week's low. This could be it, boys and girls, and them. I have to be careful these days. This could be it. Beautiful rejection at the highs on Euro odd. Euro CAD rolling over. So we are starting to show some signs of strength in the New Zealand and Aussie pairs. Lovely rejection going in. So let's see what happens. This is only 4 hours. We need to give it another couple of candles. Euro US dollar. US dollar's getting hammered, I think. Wow. Okay, let's quickly check the news. EU, von der Leyen, rearm Europe could mobilize close to 800 billion. Italian unemployment rate. Kremlin on report that White House seeks plans for Russia sanctions relief. It's too early to comment. Okay, so I don't quite know. Market is dumping the US dollar basically. So this is there you go, US dollar CAD 125. So this is less of a New Zealand move, Aussie move, than a Canadian US dollar collapse. Gold will be off. Probably oil as well. Scared spiders use phone as a torch, 2 a.m. Has anybody in here got a dog that molts, or rather that doesn't molt? I've got a cockapoo, and she doesn't molt, so we have to take her to get a haircut very regularly. Every now and again, when she gets a really bad scratch or itch, she scratches it, and because she doesn't molt, obviously a clump of hair comes off sometimes, and it always looks like a spider. So my wife got up yesterday in the night, and the dog howled last night for some unknown reason. She had one of those dreams where she just went ooh in the middle of her sleep, and we were like scared the crap out of us. And then she sat there and went, "What was that?" Got up, had a scratch, and she left a spider fur on the floor. So yeah, if you got one of those dogs that doesn't molt, they leave spiders lying around the house. Every now and again, you'll just be walking around, you're like, "What's that?" And you have to go and look at it, and quite often have to get something to poke the fur with just to make sure it's not a spider, because fur doesn't run, obviously. Spiders do. Yeah, there's my spider story. Right, so yeah, we'll see what happens with this. If this is a US dollar drop, you're going to find, obviously, money has to come out of the US dollar. If it comes out of the US dollar, it has to go somewhere else. This could be the start of the profit take move on the Australian pairs. So we will see. So could be reversal day today, could be payday. So, we're looking with most things for a 150 ADR move, really, which is on the cards. So US dollar CAD coming down very hard. The 4-bar reversal there over 4 hours. But again, we're just back to literally, we've just done yesterday, haven't we, really, with most of this stuff. So we're just it's just the start. We'll see if we do get a continuation though on this. There you go. So Aussie US nearly back at break even on that. So these euros are the main problems at the minute. So I need a 175 ADR move really on euro odd. Euro CAD need 175 ADR. Lovely rejection though. Swings and roundabouts. Every time you get into profit on something, something else goes into drawdown. That's part of position trading. Right, I'll leave it there. If you've got any questions, let me know. If you want to do some testing on these, go ahead and publish your results in the members group or in the main group, and just share set files with it. But obviously, just make sure when you're doing these tests, you do set it to, whoops, wrong one, long only. Yeah, in the tester. So set it to long only. If you're in MT5, you don't have that. So in MT5, in the inputs, you have take long trades and short trades only. I specified those as inputs because you don't have it in the tester. So, but yeah, obviously just make sure it's long only, because if you run the test and you get confused because it's not getting the same results, it's probably because you're taking shorts. So just bear that in mind. But yeah, share your results if you get them. Like I say, it's not the sort of thing you're going to make a fortune on, but I don't know, you might consider that to be a fortune. If you got 50 grand lying around in premium bonds, for example, as I had, you can make that. Well, that's one of the things I did. I withdrew all my premium bonds and put it into this, because although it's not tax free, outperforms premium bonds by $1 billion. If you're not in the UK, you don't know what premium bonds are, ignore that. It's just a savings, tax-free savings plan, basically. You can only put 50 grand in it, though. Stick 50 grand in here. That's a good one, yeah. So if you've got premium bonds in the UK, just before I go, you'll know that every now and again you win £300 to £400, £300 to £500 as a prize for having 50 grand sitting there. Thank you very much. If you'd have taken your 50 grand out and put it in 2023 into an S&P long strategy, you would be sitting on 86,000 profit, yeah, on your original investment. So your balance of 50 grand is now 135. Admittedly, you'd have had a bit of a scary Joe point where you had to go to the toilet with your phone because you were 35 grand in drawdown. However, you wouldn't have been far away from ADR of an exit. There you go. Good strategy. Right, I'll leave you with that. Anything you need, let me know. I'll be back tomorrow afternoon. We'll trade the S&P and the NAS in the afternoon. And we'll see what goes on today with these moves. But so far, we are starting to revert. So fingers crossed that we keep these reversions in play. If we get these reversal alerts in on the hourly, that's half the battle. So this will be the first reversal alert we've had for a while. We had one there. But yeah, we'll see where we go. All right, so have a good day. Anything you need, let me know. Other than that, I will see you next time. Have a good one.